Welcome, everyone, to the Pirates of Finance. Near Christmas edition. Holiday edition. I once again, I'm impressed with us. It's a Friday. It's 3 p.m. We're recording on schedule. Didn't even start late. Went off without a hitch. Let's keep things running smoothly, Jason. Let's hope my microphone doesn't pop. Let's hope the cameras actually work.
I like how you, if people don't know behind the scenes, I love when this starts, all of a sudden you're chipper and smiling because you're usually right up until start the show.
I'm so frowny before we go live. Well, no, I'm just centering myself.
You're in a fit of rage before we go live.
Look, we got to say the usual disclaimer before we dive in here because there is a lot to talk about this week. Right. This is not financial advice. This is two random guys on the internet. Do not interpret this as financial advice. Check yourself before you wreck yourself. You know what I'm saying? If you're listening to us just audio only, just so you know, we are two random dudes on the internet. Like, just because you can't see us doesn't mean we're not there. You know, make sure you talk to a professional before you make any sort of investment or investment related decisions. So with that, Jason, this was a big week. And I know you love talking macro. So I'm going to go the exact other way, which is talking micro.
There we go. Now we're talking.
Because I know the last thing you want to talk about is CPI and Fed and were they hawkish, were they dovish? I honestly couldn't give a shit either. So let's talk about something I actually think is pretty cool. And it's something we talked about on this channel over a year and a half ago. So do you remember we did an episode a year and a half ago that was filled with Scooby-Doo cartoons about what we called the crypto mystery trade?
Yeah.
And this was like the worst kept secret among crypto quants and I think a lot of other crypto traders that we talked about that there was this trade that existed that could be exploited if you knew what you were doing. But I didn't want to just give it away because I knew people who were trading it and making money on it. And I felt bad just disclosing what it was. I was trading it for a while, making money on it, ultimately stopped trading it. Well, now that FTX has gone down, we can disclose what that trade was because it's never coming back. And I think it's such a brilliant example of what Edge is, right? And I think when people get into investing or trading, they're told they got to find Edge and they don't know what Edge looks like. I think sometimes a really concrete example of, oh, this is what Edge looks like in a certain scenario can be really illuminating. And so there was this great thread that was written by someone who was trading this for many years, claimed successfully. I don't know whether they were, but I know the trade existed that went into exactly what the trade was. So I thought it might be fun to just sort of walk through this trade, Jason, and talk about what this Edge was. So you want to go on this journey with me?
Yeah, please. I think, correct me if I'm wrong, I think when we talked about it before, this is when you brought up what Edge really is, because you were showing like how in crypto there's actual Edge where like I think if I recall correctly, we were talking about before, it's like, you know, people call it things Edge these days. Even they even call it ERP an Edge for all I know. And then they, people throw on the term arbitrage when there is no pure arbitrage anymore. So we always keep changing these words around to mean being different things. But if you traffic in the esoterica like you do, there is ways sometimes actually to find Edge. And so that's
and true arbitrage does exist every once in a while, right? There are pennies left
once
over.
In a while.
I remember there were all these NFT liquidity pools that if you were savvy, you could swap liquidity in different pools and make pennies of arbitrage. And hey, that adds up after a long time.
There was
not one game, but
one last thing. Our buddy, oh my God, I'm just blanking right now. He had a great tweet the other, and I'll remember what it is in a second. It was Ewan Sinclair had a great tweet about structures are not strategies when it comes to options. Speaking of Edge,
yes.
You know, they tend to sell retail that options structures are Edge and they're yield trades, but they're not. They're just a structure. That's not a strategy, nor does it have Edge.
Yeah, Chris Sidiel has said that for a long time on Twitter. A structure is not a strategy, right? So, hey, an iron condor is not a strategy. It's just a structure, right? It's just, and it shouldn't necessarily have Edge. So the author of this thread goes by Adley_ETH on Twitter. Current handle is not here, an anonymous account. Great. I retweeted it. You can scroll through my tweets from earlier this week if you want to find it, or you can look up the original author. Great little thread about what this trade was. So let me talk about what this was. On FTX, on the exchange, they had a couple of tokens that were listed that were synthetic trades. So for example, one of them was gave you daily leverage of an underlying cryptocurrency. ETH Bull was the name of one of the tokens. And if you bought it, it would give you 3 times the daily return of ETH. Well, how is that achieved? Well, they actually had to go in and buy futures every day and reset that leverage to buy the appropriate amount of notional exposure so that at the end of the day, you got exactly 3 times the return. Well, FTX decided that they were going to publish the schedule with which they were going to do this rebalance, right? And it happened at 0002 UTC every single day, which I believe is about 8 p.m., 8:02 Eastern. And the trades would start firing off, and you could actually calculate based on the assets that were held tracking the token, which you could use their API to figure out, and the prior day's move, how much they were going to have to trade to rebalance. And you knew exactly when they were going to trade. And you knew exactly how they were going to trade. Because if you watched this for a while, you saw, oh, they do a blast of about a certain amount of money and then wait 20 seconds. And then a blast of another amount of money, wait 20 seconds. And then it was every 7 seconds or so. And so what that gave you the ability to do is say, I know who is across the table from me. I know exactly what they're going to trade. I know exactly how much they're going to trade. And I know exactly when they're going to trade. And that gives me the ability to potentially front run that trade and provide them liquidity. And so that edge existed for a really long time. And then this is a great story about like the transformation of edge too. Because once enough people caught on to that, people started front running the front runners, right? And this is how edge disappears. And so then for me, when I was playing this, I stopped trying to front run the trade. I knew that everyone would be trying to exit the trade. So I started to try to go the opposite direction, which was to play the mean reversion trade, knowing that everyone was trying to exit. And so there's all sorts of ways this can be played. It was such a fascinating little microcosm of history, but I think it's such a great example of when you're poking around for edge in the markets, and this is the type of stuff that can never be bundled up in a mutual fund or an ETF. This is just like, this is intraday trading stuff. This happened over a minute. What a great history lesson in like what an actual edge can look like. And the things you have to consider, like how big were these moves? They were 50 basis points, 100 basis points. Well, now all of a sudden execution really matters. You know, you do taker fees and you're paying 10 bips to cross the bid-ask spread. All of a sudden you're eating into a huge amount of your profit. All that stuff starts to matter. But this was such, to me, a great isolated example of what an edge truly is in its purest form.
There's so many things that, like, I think about, for a lot of time, people are trying to front run JP Morgan's hedged equity, right? And they started trading the strategy style a little bit that threw a lot of people off. Or what works great on that is like 60% of the time, works all the time, is like, it's worked the last 5 times out of 5, and then they change it up on you for the 6th. Then you've taken on a bunch of leverage because you thought it was a sure bet. And then, like you're saying, even with like somewhat edges and seasonality, like you said, once everybody, especially the academic papers come out, that ARB's completely gone. But like also people have been front running and moving it, closer and closer in time. And if I recall correctly, I remember when you were doing this, is like, yeah, you kind of figured out, but you kind of backed into it, didn't you? Did you figure it out by just seeing the trading volume one day? And then you figured out that that's when they were rebalancing? I can't remember exactly when you...
there was... I was doing some work around these perpetual futures and their reset period. I don't remember what clued me into it, but FTX very clearly had on their website, like the schedule was there for all to see. Talking about if you looked into these tokens. So like, this was one of those cases of like, this wasn't even a hidden trade. This was like out there, available. Anyone who took the time to learn what was trading and how it traded, potentially had the opportunity to see like, yeah, that could move markets. And we laugh at how we sometimes, like, traditional finance looks at crypto and is like, oh, how childish. This is exactly how levered ETFs work, by the way.
Yeah, exactly.
But most of the time they just do a market on close order.
I was about to say, that's the way around. The workaround's a market on close.
Right. And so how do you do that when markets don't close?
Right.
It's a non-trivial problem. The other really interesting thing that happens here is you typically, when you're talking about building these products, you don't want to ever have an amount of leverage that you're going to hold over a period where the product could fall an amount equal to 1 over the leverage. So if you have 3 times leverage, you don't want to ever just hold it naked over a period where the product could lose 33%, 1 over 3. You know, if you have 2 times leverage, you don't want to hold it over a period. It could lose 50% because that's how you get wiped out. Well, crypto is the type of asset that can move 33% in a day, right? So if you had this 3 times levered product, they actually then had to introduce intraday rebalances. So it got to the point where actually you had to track this throughout the day and figure out, was it going to rebalance? Well, that's another time you might be able to play the edge. And then at the end of the day, if they had already rebalanced intraday, you know, it was going to affect the amount that they were going to rebalance at the end of the day. But these sorts of, again, like they're minor complications, they're important complications, but for the most part, the edge was there for all to see. We knew who was trading. They were you knew they were going to trade. It's not like they just ever decided not to. It was completely programmatic. You knew the direction they were trading. You knew the amount they were trading. You could look at the order book, estimate how much impact they were going to have if you wanted to take it that step further. And by the way, they were doing this across dozens of tokens. And so you could diversify the way you were trading.
You already answered some of my other questions because I remembered at the time, like you showed me, like you said, when it was at 8 p.m. And then I think at one point they started doing it twice a day and then throughout the day. So you're looking at those different times. But if I recall correctly, I remember you're showing me in live some of the times is like it didn't work every time, or that's when everybody kind of glommed onto it, where then they started coming shorter, but like it wasn't. I think you would show me like 4 out of 6 times or something it worked, but it hadn't worked.
It definitely wasn't guaranteed to work every time. Right. It largely depended on what was happening in the market. If there was activity going on, it depended upon what the order book looked like. It got a little weird sometimes too, because the way these tokens trade is they're sympathetic movements, right? I don't know, Cardano might be highly correlated to ETH. And so what happens if Cardano was actually, the levered token was supposed to sell down, but ETH was buying? Well, was Cardano's downward sympathetic movement actually going to get offset by the correlation trade and how correlated it is to ETH? So there were definitely complications there. I think the author of the Twitter thread made it sound easier than I think the trade really was, but they might have started trading it long before I did. Maybe they were just smarter than me.
Yeah, because I think that where you eventually got to too. Yeah, you were looking at the correlation trade because you'd be like, ETH moved this much last time, so I'm going into this one. Like a correlation trade would say Solana or whatever it was. Like, isn't that what you eventually got to? And I'm thinking about too you, and then what you pointed out too is like after figuring all that out, then you start playing the mean reversion after the event, right? So what was the event? 2 to 5 minutes? Like how would you also, that's a execution time frame where you got to jump on that mean reversion too. So how did you manage that?
Yeah. So again, it all largely depended on how much was actually trading. Like if they were having to execute an amount that was going to take 2 minutes of buying or 2 minutes of selling, right? The mean reversion, you know, you might be delayed your execution 2 minutes and then trade for a minute. So a lot of it was dependent upon how much volume they were dumping into the market and how much the market moved at that time, right? Because you don't want to take the mean reversion trade if they're dumping a very small volume and the market doesn't move at all. There's not going to be a mean reversion trade, right? But it got to the point, by the way, that the mean reversion trade wasn't about what they were doing. The mean reversion trade was about everyone front running what they were doing. Because if everyone front runs that trade and then tries to provide liquidity into it, it's a question of who's the leftover bag holders. Was there too much liquidity bought to sell into it that now people have to close their positions? It gets complicated, right? It's a constant arms race. But again, the core point I want to get back to here is not like this stuff is super complicated. It's the nature of Edge, right?
Yep.
And in this case, you know a party who has to trade. You know exactly what they have to trade, when, how much. That is hugely valuable information in terms of trying to identify an edge. And I think the more we move away from that, right, the less we know about who the counterparty is, why they're trading, what they're trading, and when they're trading, the more it goes from like a pure edge to a statistical edge, right? You still might be able to find these statistical anomalies, but you just have far less certainty about them, that they're going to continue to exist, or that you can purely quantify the nature of them, the less you can answer those specific questions.
Yeah, 2 questions related to that one. And one you already started to touch on, but I'm glad I brought up Ewan Sinclair earlier because Ewan and I had a long talk about this. And like the idea of, if you find edges disappear so quickly. So like you said, you couldn't have it in a mutual fund or anything, because like you have to be able to jump on these trades, whether it's in crypto or not. Like any edge in markets tends to dissipate pretty quickly as everybody tends to jump on it and figure it out. So you and I had a long discussion about, you can't have a back test or a historical database or a white paper written by an academic that says here's where edge lies, go find it here. Like it's long gone by then. So we were talking about like maybe the role of the solo trader, the prop trader, the DIY trader, is to find these edges that you see are mimicking edges you've seen before. And then it's your best guess that this edge will persist for a short period of time, but you have no proof of it. And so therefore it takes a lot of a risk and guts to kind of put on these trades.
Yeah, 100% agree with that, because it can take a lot of effort to try to find this stuff, and then you don't want to share it, right? Because you know for a fact, like if or people who discovered this edge early, that edge is going to disappear over time as more and more people discover it and more capital chases the same impact, right? This is how alpha decays, and you could literally watch it. I'm sure I have friends that actually could probably help me piece together like some history of this trade, right? Rewind to I don't know, early 2021 and look every night and see how the price reaction changed over time. Because my guess is you would see the amount of actual market impact happening from the trade decrease over time as more and more people tried to front run this trade.
Shoot, I totally forgot what I was gonna. There's something in there I was gonna say, but I'll think of the next question I was gonna go back to. How do you define edge as far as like, do you think it's fair to say edge for commodity speculators is they're providing risk transfer service to non-economic hedgers? Is that a form of edge? Or I'm pretty sure you're a fan of seasonality. Is that a form of edge, or how would you classify those?
Yeah, so I think this goes to, is it pure, like, is it arbitrage? It's not arbitrage. Arbitrage is like a pure edge, in my opinion.
Right.
Is it as pure an edge as this example? No. I think when you talk about someone like commodity traders providing liquidity as to like the source of their alpha, that's pretty ephemeral, man. Like you can't prove that, and you can't disprove it. So it's an edge hypothesis, but how much confidence do you have in it, right?
Well,
and so to me, it goes to like, the less you can answer that stuff, right, the less certain I am about the edge existing. ERP is a really good example. So the equity risk premium. I would argue, at least in a philosophical vacuum container, that there should be an equity risk premium, because otherwise, why would you bear the risk, right? You want to be compensated for it. But most people aren't sitting down and doing the calculus and being like, well, is the equity risk premium high or low enough? They just sort of go like, how much are bonds offering me? What's the utility I need? And then, for the most part, in the US right now, people just throw their money in a glide path, right?
Yeah.
And so it's hard to argue like there's a lot of like thought about the ERP going on. Maybe that's why you see, right, the emergence of bubbles, is that people aren't thinking about ERP, right? We're not all rational all the time, which maybe is another source of edge. But yeah, I mean, arguably that one should persist. But is it an edge, or is it just sort of the nature of risk? Like it's sort of like credit risk. If someone comes to you and wants a loan and they are likely to default, you're going to ask for a much higher interest rate.
Yeah, I wonder, like, like you said, ERP should exist. Like, does it exist, and over what time horizon? And like you said, you have ERP, then we have VRP, volatility risk premium, and then I haven't even heard it. Like, what do we call it? Credit risk premium, right? Maybe we should say that. And you say it should persist because the whole
term risk premium.
Yeah, term risk. The whole theory behind it is like you should get paid for taking risk. But I'm like, is that a truism of life in general? I'm not so certain. And like you said, people start having these Minsky moments where they build that up, and then you get the commensurate drawdowns on those risks. So that's what I'm saying. If you can have negative ERP for a decade plus, is there really positive ERP, or like it's a really a timing mechanism?
And how do you deal with the fact that ERP varies historically dramatically in different countries? Right, the U.S. ERP has been a dramatic outlier, and can you even time this stuff? Right, which brings me to another. I'm going to use that as a segue into a different topic. Did you read this? I'm holding up, for those of you just listening, I'm holding up the Lux Ventures.
Did you get that by carrier
report.
pigeon? How did you get that?
I like to print things, man.
All right. All
You
right.
know,
All right. Sorry, I cut you off. Say it again. The Lux quarterly report from Josh
yeah,
Wolf.
Lux Ventures quarterly report from Josh Wolf. It's their Q3 report, so it's out on a delay, couple month delay, but he published it this morning. And I thought there were some interesting points here. It's sort of, for those who track Josh, I think he's a very smart mind. He thinks a very good writer, someone who's able to really clearly express their thoughts. I always enjoy reading what he has to say. But there was a couple of things in here, and I don't know if you read this. A couple of things in here I wanted to. Great, this is even better.
By the way, if we ever had, we can't have Josh on this show because we sometimes do the handsome pull for as a joke that Tyler does to us. And if we had Josh on here, we'd just get blown out of the water.
We get smoked.
Yeah.
Josh is super handsome. There was a couple things in here that I wanted to ask you about. One, if you do read it, there's a dramatic amount of like market timing at the venture level that Josh is talking about, where he's guiding his companies as to what to do and not to do in different parts of the cycle. But I thought this was really interesting from a business perspective. So now taking off, my quant investor hat, thinking about my business hat, running a business, he said that his message to companies right now, so his first message years ago was raise as much cash as quickly as you can because the market environment's not going to last. Then his message became hold on to that cash. Don't spend it. You're going to need it. His message today is don't spend that cash on growth. But instead, if you do spend it on consolidation. Roll up competitors, their talent, their customers, and their channels to market. Strong balance sheets will beat weak cap tables. I wanted to get your thoughts on that because I think it's a really interesting one. It's a market timing call in many ways as to like where we are. But two, it's a really interesting way to think about internal corporate ROI.
Yeah, there's so many things in there, but like you said, that should be the job of VCs, is right. Like not only you want them, for their money. Money is a commodity, so you want more than their money. You want their wisdom, and obviously Josh is a very smart person. Whether he's right or wrong is another question, and then it's always a question of timing. When do you deploy that capital? But obviously, it's a man after my own heart. I mean, this is why we use long volatility and tail risk, because I always say is like a dollar is not worth a dollar in a recession or a liquidity cascade. Right. It's a convex cash position. And all of a sudden, a dollar's worth a hell of a lot more if you can pay cash for things when everybody's scrambling for cash. And more importantly, you're restructuring or restriking that lower NAV point where then you can buy up your competitors for pennies on the dollar. You can make payroll, or you can buy up, real estate or do any sort of, CapEx financing for pennies on the dollar then. And that's what leads to long-term compounding at a much better rate or business survival. So it's interesting, like you're saying, to look at it in the business sense. I mean, I always have that in general because I think about what we do as, tools for entrepreneurs or entrepreneurial put options, those sorts of things. So it's always on my mind. The question is the timing of it, right? Like how are you going to know when it's deployed? I mean, obviously, if they're still sitting on the cash, it's basically when your competitors come to you begging to, take everything off their books, either for like taking on their debt or, for a dollar or something like that. But like, how would you think about it?
Well, I think that's right. Look, I run my business conservatively anyway. We talked about this last week. Of just like, how much debt are you willing to take on? I just went through the exercise over the last 2 weeks of going through every bill my company's had this year and aggressively negotiating with service providers because I'm just a cheap bastard. I think everyone should do that. If you don't negotiate your bills, you're leaving money on the table, which is, strengthens my balance sheet and makes me more profitable and makes it more likely for me to survive. We can get into that in a minute. But yeah, the question always becomes, right? It's the Warren Buffett. I don't even know if he said that. Who said buy when there's blood in the streets? He says it all the time. Who's the original?
It's everybody goes Buffett or Rothschild, but I actually think it was J. Paul Getty.
Nailed
it. There's probably somebody before that too, because I know you're getting mad about the attribution game.
I have no idea who actually said that. Now that I think
Turtles all the way down.
Kind of embarrassing, but right, you're supposed to buy when there's blood in the street. It's not always obvious when the blood is going to stop flowing, right? And so the problem becomes when you have a competitor who's going under, or you think it's a great time to acquire that competitor, their clients, and their distribution channels. The question is, how long does that integration take? If you're buying them and it's a shotgun wedding, what sort of cultural integration is there going to be? How many clients are going to hold on right? How many of those marketing channels are still going to be available to you, or distribution channels are going to be available once the actual acquisition occurs? None of that is obvious, particularly if a market's in free fall, right? So it's one thing when the market is strong and a competitor is going out of business for maybe reasons that, whatever, it's still a good like an asset you want to acquire. Great, you can raise some financing and buy them, and it's maybe not that big a risk. But when the economy's in free fall, just because you have cash doesn't mean the best use is acquiring that competitor necessarily. Maybe just let them go out of business and buy the asset in bankruptcy.
Yeah, no, that's or I hate to. I wish he'd go away, but to talk about Beetlejuice again, I mean, he was buying up all those crypto companies when we thought there's blood in the street, but apparently there's a lot more blood to flow through the streets. And
Right.
you're trying to catch that falling knife. But also, it made me think about like your aversion to debt and everything. I wonder, is like you're saying, when the good times are rolling and credit is awash, right? Like you said, you can finance the purchase of your competitors. When there's blood in the streets, you're going to have to use that cash to buy competitors. But then you can almost double your returns by then when the markets rebound, if they eventually do, and you made a good purchase, then you could put some financing on that debt, and now you've increased your compounding. I'm just wondering if you ever think about it that way too. It's like, I know you have an aversion to debt, but like pay cash if it rebounds, and now you've tripled the EBITDA. Like, would you then put a little bit of financing to cash yourself out in a non-taxable event?
You have a Josh has a great quote here, which ties exactly to that. Entering at a greater fraction increases the odds of exiting at a greater multiple. Right?
He's got the great quips. What is it?
Really
chips on shoulders, put chips in pockets.
Yeah,
is that what he's known for? Yeah.
He's really good. He's really eloquent. I'm going to steal some of these. No, yes, right. But then the question becomes, how much of your own personal balance sheet do you want tied up in the business? How do you want to think about that separation of church and state? Because if you're already taking on all of this entrepreneurial risk, right? Do you want to double down on that risk? Double down on yourself, or do you want your personal balance sheet to be your fortress in case everything goes belly up? And then, by the way, if you're at the point that you don't need to use your personal cash anymore, I think the ROI opportunities typically are lower because you're just a much more stable company. So it's this horrible trade-off, this gut-wrenching trade-off sometimes as an entrepreneur of going, you get to that point of stability and you can get that nice credit line from a bank, or you can get reasonable financing in other ways. And not all the ROI opportunities are as high as they were when you were in that hyper growth mode and starved for capital.
Yeah, at the risk of self-promotion and not investment advice, is that businesses and individuals don't think about their risk more holistically. And quite frankly, if you're taking a lot of risk as a business owner or an entrepreneur, if you have anything left over in savings, it should be on long volatility and tail risk, so you can hedge these risks out. And when these things happen, have a convex cash position.
Yeah. All right. So let me talk a little bit more about what's in this letter. So Josh talks about specific strategies they've developed. And honestly, by the way, this reminds me so much of Diego Perea, because the strategies they've called are bubble, anti-bubble, and consolidation. So for those of you who don't know who Diego Perea is, he is a tail risk manager out of Spain, I believe.
Out of Madrid, but shout out to Diego, and more importantly, 36 South and my boy Jerry Hayworth. Diego is going to join the investment committee at 36 South in London, so he will no longer be out of Madrid. He'll be out of London.
That's right. So he talks about the bubble, anti-bubble, and consolidation strategies that they advise their portfolio companies on. And so what is the bubble strategy? Well, the first strategy is for deploying future capital. And you would think, in my opinion, before I read this, right, what do you think a bubble strategy is?
I don't know, just going balls out. I don't know, spend everything on cash.
That was my thought. I was like, okay, you're in a bubble. You have to go on attack because everyone else is going to go on attack.
Yeah.
And so you have to it's sort of this everyone's misbehaving type of situation, right? And so if you don't misbehave as well, you're going to get put out of business.
But the way you're saying in this scenario, he's going to go your counter cyclical to those things, right? Is that what you're saying?
He says, put yourself in a protective bubble.
Yeah.
Immunize yourself from the vicissitudes of markets and geopolitical chaos. And he says that Lux is giving companies 30 months of cash, 2.5 years of runway to weather the storm and come out strong and distinguished.
That was because you already front ran my question. Then my question was going to be, what is Lux doing on their side to help these companies, and do they have dry powder? And it sounds like they do. And that's what then that necessitates another question. I think I saw on, of course, it makes me laugh every time. On All In, I think Chamath was saying too, like that people need to have a runway through the end of at least 2023. Maybe he said 2024. So
Yeah.
in this scenario, how long do you think is a good runway? Like they're recommending 3 years at Lux.
I think it depends on the nature of the business, right? I mean, like honestly, that it depends on what your fixed costs are and your ability to dial up and down your costs. So, very transparently, in the business we are in, right? People tends to be the highest cost. I just did this exercise as well this month. People tends to be the highest cost, and then you probably have rent, which is depending on where you are, can be a decently high cost. Benefits, so not just payroll, but payroll, taxes, benefits. My guess is for most asset managers, that makes up like 60 to 70% of the cost, right? And then you're probably talking D&O insurance, that sort of stuff. That's not going to be cheap, right? So there's a lot of like fixed costs.
I just like we're both talking about what's basically been on our mind this week: insurance.
Yeah,
costs.
well, by the way, insurance costs go up every year. Why insurance goes up with inflation, I don't know, but I'm expecting my insurance costs to go 15% this year. Regardless, I look at my costs, and I keep costs pretty tight at my company. I just talked about I spent the last 2 weeks arguing with vendors trying to negotiate prices down, as I do every year, because I think it's a good exercise to stay lean. But at a certain point, like you're cutting into bone or cutting off limbs, right? I run a very lean team. It would be very hard for me to fire people into a downturn and not take a material impact on my ability to generate revenue.
Well, there's several things in there. One, by the way, you use Truebill for your personal stuff to see where you're
No.
spending money. I need
No,
to start doing that.
I do not want to know where I am spending money personally.
No,
That would bring
I
me
don't.
so much discomfort to actually know how I spend money. That's the last thing I want to know.
Yeah,
I want to know
for
for my company precisely
Yeah.
to the penny, but my personal expenses, man, no, I don't want to know.
No, I do not want to know my personal teeny budget. But I was saying more like Truebill is like to know like where you're over. Like you might have like 2 Netflix subscriptions or something, like all those, like where you can find like those things that you could cut. But the other part that you were saying though, that I think it's because you've been around the block and up and down several times that you realize it's not cutting to the bone right now. It's that during the bubble phase, during the expansion, you didn't dramatically expand your team. And that's where everybody makes the mistake. As soon as they start bringing on more AUM, they're like, we can grow with this AUM. Like that AUM is going to be stable and growing. And this is a very fickle business. It's really odd business to run. Quite frankly, as an entrepreneur from many different domains, it's always, it's not a fun business to run with fluctuating AUM. I don't know how anybody runs this business. And that's what happens every time is when people get like an institutional check, for 250 million, 500 million, all of a sudden they start onboarding all these team members. Well, if 18 months later that institution pulls, now you're going to have to cut half your staff. Or if there's a downturn and you're not providing P&L, like you're going to get cut. Or quite frankly, if you do your job and do well, but everybody else is bleeding to death and you're the ATM, you're going to lose AUM.
Yeah, I don't think it's unreasonable based on my experience that if you're very good, clients stick with you for probably 5 years. All right. And then there's just happens to be, especially if you sell to the advisor channel, an advisor gets acquired, they can't bring your fund with them or they retire. I just tend to find like if you're good and the assets are sticky, most people say 3 years. I think you can get to 5 years. That's been my experience, at least. If you really white glove service with your advisors. So you're talking about losing 20% of your assets every year just in turnover. So you got to overcome that hurdle. And then you have the variability of asset fluctuation, right? So if you run, let's say your blended revenue weighted sort of asset exposure across the mandates you run as a 60-40, you got 12 vol to your assets. So, okay, the market went up 20% this year. Great, you're feeling rich, your revenue's up 20%. Well, next year it's down 20%, right? And so you can't just look at AUM growth, particularly, or revenue growth from the market. You kind of need to back that part out and say, hopefully there's a long-term trend there. But just because it ran up 20% end of year, and your run rate's way higher, does not mean you want your expenses up there, because the next year it could be down 30.
Oh, I was waiting for you to finish the thought. You're popcorning like crazy again. Do you
Well,
want to unplug it?
I cursed it.
I was trying to wait quietly, but it started getting worse and worse and worse, and you were on a roll, so I didn't want to say anything. I have a question though for you for what Josh is saying there. Is what do you think the fiduciary responsibility to the VC is, right? Is it to their institutional allocators, and are they supposed to do what it says on the tin and just allocate to all of these venture capital companies and really deploy all their capital? Or do you think it's a fiduciary responsibility for Josh in this case to keep some dry powder on so that way he can make sure those businesses survive? I think that's a tricky one.
Yeah, fiduciary responsibility is great territory, right? I don't think it's black and white. And so I think it largely probably comes down to Josh communicating what his fund is going to do. And as long as he's clearly communicated that, he can operate the fund the way he sees fit. And he talks about the fact that they just raised a fund. They blanked out some of the details, but raised a multi-million-dollar funding round to help provide companies that runway of cash in sort of this bridge round that he thought was really necessary to make sure that the companies that he believes in have the ability to sort of protect themselves with this bubble.
I was actually wondering if would it be proper, unjust, or undue for Lux to take on a little bit of debt in that scenario, and that's how they provide the cash flow instead of just raising another equity fund.
Yeah, I've never really heard of a VC taking on debt to help support their companies. I think it's a question of like whether that's going to
prudently.
Yeah, that's an interesting one. So look, second strategy. So the first strategy is the bubble. Second strategy is anti-bubble. And he calls it their special situation strategy. And he says, when the financial bubble pops, there's going to be great companies that are suddenly but quietly available at great prices. Strong businesses with weak cap tables populated with overconfident but under-reserved investors tapped out who can't or aren't able to support some of the future financing needs of their companies. And so he's basically sort of, again, like, I don't think Josh is shying away from the fact that like there's a big market timing element to both his strategy at Lux and the way he advises these companies. And he's saying the anti-bubble strategy is thinking about that special situations play.
But okay, once again, the timing of it, like, I don't think, newer investors haven't really seen how painful the blood in the streets can get. And to me, it feels like, there's a lot of pain, I think, in VC land, in NASDAQ stocks, and potentially even on private equity deals to come, potentially, right?
Yeah.
But until like that pain gets so great, that's what I'm saying. It's like easy to talk about deploying capital now because you're very calm and it seems very easy, right? When the time comes, it's usually so chaotic and there's so little capital and you're so stressed out that like you just get into paralysis mode.
Yeah.
Like I think about when. Go ahead, sorry.
Sorry, but I also wonder, I think part of this, by the way, is a strategy at Lux itself that they look to sort of be, what's the word I want to use? Exploit the weakness of other VCs, right? To find great businesses that other VCs have already sort of spent all their capital and come in and refinance, scrub those VCs out, clean up the cap table, and take it out at a great price.
No, that's what I would be doing. Yeah, look for, and Josh is actually, even way before this paper, I want to say a year or two ago, Josh was talking about that. Is like, there's going to be a lot of weak links to cap tables. And if you have a strong balance sheet, you can just come pick those off when people are desperate for liquidity. Because like you said, there was a lot of people that were just jumping on board. I think a lot of people that with a Twitter following started a VC or PE company, and they were just following on A16Z or whoever and not doing any due diligence. And they were getting onto cap tables. And like you said, like if you need liquidity and you're a desperate player, there's a lot of ways to clean those up. And then not only that, you can get a lot of covenants when you do that too. So you can really put the screws to it. I mean, I think we've talked about on the show before, like maybe a long time ago, is JP Morgan made all of his fortune, in 5 crashes. And it was more like your price, my terms. And he just really screwed people in terms. And then I think about when, when I was saying like, I don't know if fear's fully set in yet in the sense that, Howard Marks, late 08, early 09, was deploying, billions and billions of dollars a week. And because there was so much blood in the streets and so much paralytic fear. And then he was set up, ready to go again in 2020. And we never saw those discount in prices. And so, now are we starting to see it on the VC and maybe NASDAQ side? I don't know. But usually that fear is like, it's almost palpable. Like you can cut it through you can feel it in the air anywhere you go. And I don't know about you, but I'm not quite seeing that in society writ large right now, but maybe it's isolated to VC land.
Yeah. Not seeing forced liquidations anywhere. No one's panicking. Your average retail person I talked to goes, "Oh, the market didn't have a great year, but you want to know what?
Right.
The Dow Jones is basically flat.
Yeah.
It's down like after today, it's probably down 7%. It was close. It was up to like, maybe down 2% earlier this week. Like again, boomers doing just fine in their boomer index.
Yeah. Or the home equity may be down, 10, 20%. That's after it went up 200%. So
Right. So I'm not sure there's any max pain out there. I think the pain is in VC land where you had cheap money being used to fuel user acquisition that never got to a point of sustainability, right? All these apps like Bird that all of a sudden the pandemic wiped out, a huge source of revenue for them. And now as you're ratcheting up interest rates, the cost of capital goes way up, and you can't justify subsidizing the user acquisition for a strategy that doesn't have any long-term real profitability.
then, by the way, in the comments, Menahem was basically saying this is not profound, just hard to implement. He's basically saying buy low, sell high.
Yes.
And as you know, though, this is one of my frustrations I text you about all the time is like, I really wonder, though, the longer and longer we're in this game, if you just start sounding like these little, basic bitch Yodas, like, Buffett and Munger and all these guys that not saying in a bad way, but it's just because people don't understand the basics. Like you're saying, bubble, anti-bubble, be counter-cyclical, buy low, sell high, have some patience, have some dry powder.
Yeah.
It's maybe that's why those guys eventually get to who cares about this really interesting derivatives trade? You got to get the basics right, and nobody's getting the basics right.
Right. So third strategy for Lux, consolidation,
please.
Right? So the bubble, insulate them from anything that's going on in the market. Anti-bubble for Lux was being able to come in and clean out balance sheets and take sort of attractive chunks of companies. And then finally was consolidation, which was working with their portfolio companies to help build war chests on the balance sheet. And there's a couple interesting things here, right? It's put it in the hands. What I thought was interesting was don't leave it at Lux. Put it in the hands of the managers because they're going to see the opportunities, which is going to then flow up to Lux, right? An interesting delegation of capital, in my opinion, from a VC to trust the managers to know where the best opportunities are. But I also think there's an interesting aspect of when a firm is cash strapped, a huge amount of focus goes into figuring out the financing problem and not working on the business, right? And so I'm wondering also if there's an element of saying, hey, you've got a whole bunch of cash on your balance sheet, freeing up that company from even having to think about capital and just focus on what's right for the business. And I talked to you about this in the past where I said, I have very seriously considered raising capital at my own firm, not because I want it to grow. It would be nice. There's some growth opportunities that I would love to reinvest in and accelerate a little. But I think for the most part, I'm growing at the speed I want. That's organic and strong. I just sometimes want more cash on the balance sheet just so I can stop thinking about the balance sheet.
Exactly. I don't want to. I was talking to our mutual friend the other day, and I don't know if he wants a shout out or not, so I'll leave it. Mutual friend we were talking about tail risk and traditional ways tail risk is shown in papers, and hopefully we're not going to talk about any of those papers, but also maybe we will. But then and how people actually implement tail risk. And I was saying it's one thing to look at it from a quant strategy of how do you incorporate tail risk into a portfolio. But I think what most people are missing is, like we just said, that convex cash position or inventorying tail risk when you don't need it. So when you do need it, you have peace of mind and you're able to make much better decisions. And people highly discount that because you can't put a quantifiable number on it. With the comfort you have and the safety you have to then make better decisions is exactly what you're saying. Is you do not want to be worrying about your balance sheet. You want to be worrying about running the best business possible and out competing in that scenario.
Yeah, absolutely. Absolutely. And so the way I often end up thinking about this stuff for my own business is I look at the balance sheet, I look at projected revenue, I look at projected expenses, and I say status quo, if revenue disappears and it's all 100% expenses with zero revenue, how many years of capital do I have? Well, how many years do you really want to have assuming revenue goes to zero? Right. Okay, assume revenue gets cut in half, right? Maybe that's more realistic.
I was about to say, are you just figuring out the golden parachutes for your team in that scenario? How much
at that point,
runway do you want to give
them? Game over, right? So it is this question of runway, but it's under what projection, right? Revenue cut in half and expenses stay the same. How many, right? You don't want to start really cutting to the bone. You want to sort of maintain the status quo. Great. How many years do you have? And again, I think one of the things we've talked about in the past is like years isn't just until cash goes to zero, because when, particularly if you run like a 40 Act vehicle where you have a fund board that's going to be reviewing how qualified you are to be a manager, showing financial strength is an important part of that. And so if you get to a point where all of a sudden you're reporting your financials and they're not good, they might just fire you. So you need to maintain a certain status of strength. So it's an interesting exercise.
What's Paul Graham's thing? Like you're walking dead or you're walking bankrupt, like when you have
like
walking
zombies, like zombie companies or whatever.
Yeah. But there was a very specific one he had in BC. It would probably be better if I knew that before I spoke out loud and just bite through my tongue. But on that, with the Josh thing, all I heard in all of that, in what I always see with Josh and Lux is, and something you and I are obsessed with, is branding and marketing. What Josh is doing right now is setting him up for the next 5 to 10 years of portfolio companies, right? And he's going to be like, look, we held our company's hands. We did the right thing. We really, we laid out the macro effort. Like you just said, I don't want to worry about my balance sheet. I don't want to worry about my cash or my cash flow. Or I don't want to worry about making payroll. But I also don't want to worry about the macro environment as an entrepreneur. I want to worry about my micro business and executing on my micro business. And like you just said, if you can outsource that to your VC, that's incredible. And so by him putting out this literature and on their quarterly report, very, very smart of them. They've always been incredibly good at branding. And obviously, Josh is a brilliant guy. And this is just, to me, all I heard is they're just setting up their brand for the next 5, 10, 20 years.
Yeah, I agree. Both for ingesting capital from outside investors as well as attracting companies that would want to work with them. Undoubtedly, it's a huge branding exercise.
And I've spent the last few weeks digging into Eldridge Industries and Todd Bowley. I don't know how much you know, but that'd be great. But like part of that too is like what he does is, I think more or less, is almost like the venture capital guys like Elliott or whatever. It's basically loan to own, right? Mm-hmm. He finds companies he wants to eventually acquire, puts a little debt on them, waits for them to default on a payment, and then it's go time, and he can acquire them on the cheap. So even if you're in a bubble market, you can still be setting up for when you have that anti-bubble effect.
Yeah. So, I mean, we've talked about this a bit. Not on the show, but just between you and I. Again, I'm just not seeing the opportunities, though.
Right.
And maybe there's certain industries. Obviously, tech valuations have come way in, but okay, Goldman Sachs just laid off a couple thousand people. Like maybe we're starting to feel a little economic pressure, but by no means am I seeing like massively levered firms going bankrupt at an accelerated or alarming pace. Like there's no blood in the streets.
Yeah. And part of it too is like we've been talking about, like, I don't know if this is going to happen. I don't think it's going to happen. I don't want it to happen. But if everything else is round trip, when do housing prices round trip?
Right. And by the way, I don't want to sound insensitive to the people who are struggling to make ends meet because inflation has gone up. Like, yes, there is. I totally understand for many people, this is an incredibly difficult economic environment. And I don't want to belittle that by any means. But what I just mean from like a overall market valuations perspective, I'm not seeing the opportunity. And maybe I'm just blind.
Where I am seeing the opportunity is that lighting behind you. Do we need to talk about your?
Look at that! Look how bad
you can't get the right shoulder.
Pro gamer. I went pro gamer, Jason. Wait till you see. I ordered myself some really good lighting, but it's going to take like 3 or 4 weeks to come in.
I was you screwed me over because I was actually I think it was last night on YouTube. I was looking at different home office setups and gaming setups and everything, and like how you can have even the light like you have in the background, and you could put those like behind your monitor. Now there's lights over your monitor that shine down on your desk, so you don't have any glare on the monitor. I mean, it's just, I mean, we can just go so deep.
The amount of money you can spend on light is ridiculous. It is. It's funny so this mic, which was ostensibly gotten for podcasting. Yeah. I use it for all my Zoom meetings, and people are like, wow, it's a really nice mic. And I'm like, I spend 99% of my meetings are Zoom meetings. Why wouldn't you have a really nice mic at this point?
Oh, God, you're killing me. This is drives me absolutely nuts. As soon as we found Zoom meetings, like, you should be having the best setup possible, the best camera, the best mic, the best lighting, so people can see your facial expression. That's why we had meetings in person, because most of the communication is off of the verbal tics and cues and all the physical, transfer of information you're doing. And as soon as you just have a grainy, shitty Zoom video, like subconsciously people are like, why the hell would I ever have any sort of relationship with this person?
100% agree. And look, I'm not saying My video setup is really not great. And light setup, not great. Audio setup, I give it a B plus.
Yeah.
Like when you hear someone with like an A plus audio setup, you're like,
Yeah.
well, that's really good. That is just the depth of tone that comes through. I trust that person more.
So this is a great question for you because you're a little more conservative than I am sometimes, or just depends on what we're talking about, I guess. But how would you think about, because I was looking at all those office setups last night, I started justifying all that CapEx spending in my head because like we don't have a physical office. Like I could, I'd really need to build out my home office. I need to really build out my, video and mic setup, my lighting. I mean, you can really justify that in your head. So like, how would you think even these days, the budgeting now, because we just totally flipped where we should be spending money on like on our business.
Yeah. By the way, we should bring Tyler in because we're coming in the last 10 minutes
sorry.
here. But this is a great question. I just had a meeting with a $30 billion RIA who had a dedicated Zoom room.
Name
so they're an advisor to advisors. Yeah, I thought you'd like that.
You're big time. 30 billion.
But they're an advisor to advisors, and they meet with end clients, and they had a dedicated Zoom room of. Like when I had a call with this guy, I was like, the quality of the camera and lighting and the angle the camera was set up was so good. And he basically said post-COVID, they have so many Zoom calls at this point, right? That they kind of have to. And I think, look, if you tell me you're going to spend $10,000, I might say, how else could you spend it, right?
And I would ask you, where else would I spend it? It's got to be
Right.
on that set. By the way, Tyler, please jump in here. But like, speaking of Josh, have you seen Josh's setup too?
I don't know if I've seen Josh's setup, but the number, I like this wider view thing I got going on here now.
Yeah, much more space for the lights. Yeah,
this is much nicer. Why didn't we do this the whole time? I haven't seen Josh's setup. I mean, the most expensive thing is the camera, right? The lights can be decently expensive, and if you set up all the audio equipment, but if you get a nice mic, you're probably talking about like $200. Yeah, I mean, a Yeti might run you $100. It's a huge step up from this shit. Yeah. And then cameras are where you're really going to spend your money. Yeah. But again, if you have, I don't know, 20 calls a week, 52 weeks a year, and you have that camera for 2 or 3 years, I think you can justify that ROI.
Yeah, I think Josh has like a TV setup that he looks at, and then a camera that shoots him, and then he's like kind of like standing in the middle of his office, so he's not even like sitting in front of like any computer or anything. He's kind of just standing in the office talking, and it's like torso up, and it's like he's got a great setup.
Yeah, that's really baller.
I was watching. I'll send it to you because then it's ridiculous. Like Rich Roll's setup for his podcast. I'm sure he's spent a pretty penny on that.
Podcast setups. It's funny because podcasts used to be pure audio. There's so much video that goes into podcasts now. The trend I'm noticing is people in incredibly dark rooms.
Yeah. And then you got to light it. Yeah.
Right. It's like they turn all the lights off and then they have very specific lights on them. But they have entire podcast studios now. I don't know. Anyway, so the real thing I want to talk about, since Tyler is here, is that, we talk about using a lot of different social media platforms, and this all is a grand experiment for us. I don't know if Tyler needs us anymore. He is just crushing it on TikTok without us. The videos he puts together of TikTok of our show get like 10 views, and then him just messing around on his own. Oh, here's 500,000 views.
The weirdest part is that the less effort I put in, the better they do. Like, I have no background in editing.
It's the story of my life.
I would spend like an hour and a half on some like dumb 30-second clip, and then I just copy and paste something from Twitter, and then boom, 500,000 views.
Yeah, crazy. It's Corey and I. Why do we put in these years of effort for all this for nothing? But by the way, after we just shit on mics and everything, we're gonna have to get Tyler a Shure mic, because like after Corey's baritone and then the Yeti is like sitting off like there, like a little bit in the corner with echo. It's like,
I know, it's tough.
Yeah, there you go. That's better. You just got to get in the mic.
Nice.
Yeah.
You gotta just get comfortable making love to the mic.
So what? I missed it. What was the story behind your colors behind you? Your lights? What was that?
Oh, there's no story. I'm just a pro gamer now.
Okay.
Is it the Philips one? But you get to choose. Like you could go one color and it changes colors, but you're going like full rainbow.
Bro, not even that.
You got a controller.
This is great. This is great content for the audio listeners. who don't get to witness me changing the lights via my phone. Okay, let's see.
I feel like your boy Dave Nattig's gonna watch this and be like, Corey, this is pathetic. You need like 6 of those lights for this to work. And,
Whoa, very nice. Very nice.
I'm gonna a little fire, maybe a little natural
Set the
firelight.
mood. Excellent.
Yeah, you know. So yeah, there's all sorts of stuff you can do here. Most of which would probably give me a seizure if I looked at them.
Exactly. I had seizures as a kid, so I don't appreciate you doing that.
So I like this. I like the sunrise and sunset ones that sort of like just slowly move.
Yeah. Oh, I did want to bring up. You guys need to start dancing on TikTok. That's what all the comments are saying. They need both of you to dance individually, and then the booty crew will vote.
I have an embarrassing.
That's just them asking for it.
I have an embarrassing admission, which is, you know, that dance that all the kids used to do, like flossing, whatever it's called.
Yeah.
Mhm.
I cannot figure out how to do that for the life of me. I generally consider myself to be pretty damn coordinated. I don't know why I can't figure it out. My body just doesn't move that way. Apologies to my wife, I guess.
I would rarely go on a limb, but I am pretty sure I'd smoke you in dancing. But hot take.
Wow.
I got it.
Hot take. I do not want to participate in this, but that's my guess. That's my hot take, Corey. Look, based on your face right now, though, I might have went too far out on a limb.
Well, what kind of dancing are we talking about? Because here's the problem. If you told me that you know how to like salsa perfectly, I would believe you. If you told me you know how to do a perfect waltz, I would believe you. If you told me you spent 5 years in Argentina as a b-boy, you know, making money on the street hip hop dancing, I would believe you. So part of the problem here is you have built such a narrative to your life. I can't. There's a gamble. There's a real gamble. I feel like I'm more of a fairway shot, and you are just all over the course.
Well, I'll say 2 things as you're replugging in your mic because it's popcorning again. Is one, you are now at our ages now, you're much more athletic than I am, though. You're constantly actually working out and using your actual coordination. So I may be falling off there. But just to give you a hint, when I was in middle school, my sister's a year and a half younger than me, and I used to choreograph dances for us and even choreograph outfits and everything. So we had like kid and play style like dances for my sister and I in middle school. Yeah.
Did you ever do crisscross where they wore the stuff backwards?
Oh yeah. I was a Tyler, I think your mic's not working either. So no. I was definitely a hype beast, jumping on all the trends when I was younger, especially in middle school or whatever. I was also Tyler, why is he cutting himself off? Because I was going to bring it back. He's like, Rob McElhenney has lied to me. It is not always sunny in Philly. This place is gray and cold and rainy. I don't know if this is going to be my new home.
Well, Jason, I do know that Tyler needs to leave like exactly at 4. And if we keep talking, that we're not going to be able to turn the stream off. So why don't we, on that sort of note of
I have one last question for you, though. I have one last question for you before you do the outro. This is really tough. I really don't know what your answer is going to be. But what do you spike your eggnog with?
It depends on the mood, but bourbon or rum.
I was thinking you got to go rum 100% of the time. What are you talking about?
Rum.
Yeah, it depends what kind of. It depends on the eggnog, actually. Honestly, I've taken to putting eggnog in my coffee lately. That's my hot take of the day. I mean, it's just cream and sugar. Why not? All right,
it's the base for ice cream. So
everyone, thank you for joining us. Listen, excellence is difficult. Choose mediocrity. Choose Pirates of Finance. Thank you for being here. Like, subscribe, tell your friends. We're a great Christmas present. That's all I got. Remember, this is not financial advice. Seek professional help. Anything I missed, Jason?
Good to go.